On the surface, Friday was a nothing day. The S&P closed up 0.43%. The VIX fell 5.5%, and volume ran at 83% of normal.
Underneath it, the largest weekly rotation we have measured this year. Gold miners finished the week up 14.29%. Semiconductors finished down 5.52%.
19.8 points in 5 trading sessions.
And Friday is the day you could watch both halves of that trade happen at the same time. The metals were bought hard and closed near their highs. The utilities were sold hard and closed at their lows.
Same force. Opposite ends of the tape.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research. S&P 500, 7,674.37, up 43 hundredths.
Dow 53,277, up 98 hundredths. The leader. Nasdaq Composite 26,180, up 43 hundredths. Russell 2,000, 3,017, up 85 hundredths.
VIX 1513, down 5.50%.
The Dow led and the Nasdaq lagged. That is breadth and cyclicals, not megacap technology.
Uranium was the best sector, up 5.09%. Then gold miners up 2.98, materials up 2.14, gold up 1.95, silver up 1.72.
Healthcare up 1.9, discretionary up 1.15, financials up 93 hundredths.
Technology was up 11 hundredths. Semiconductors were down about 4/10 on both major funds.
And utilities were the worst sector on the board, down 2.28%.
A green day inside a red week.
Because the week is where the real move is.
Up on the week, gold miners 14.29%, silver 7.25, gold 5.45, healthcare 4.33, energy 2.79, uranium 2.54.
Down on the week, semiconductors 5.52% on one fund, 4.66 on the other, technology 3.53, utilities 3.48, the Nasdaq 100 2.41.
The S&P itself finished the week down 1.43%. The Nasdaq Composite down 2.05.
So the index barely moved, and the inside of it rotated by 20 points.
Gold miners against semiconductors 19.8 points apart in 5 sessions. That is the number to carry out of this week.
And Friday's real asset move was broad. This was not one stock.
MP Materials up 9.10%. Southern Copper up 8.69. Freeport up 7.64. Chemico up 7.24. Albemarle up 6.75. Centrus up 5.75.
Anglo Gold up 5.29. Goldfields 5.9. Wheaton 5.01. Cleveland Cliffs 4.93. Kinross 4.23.
And the big diversified miners came too. BHP up 3.63. Rio Tinto 3.06. Vale 2.53.
14 names against an S&P up less than 0.5%.
Now the part we measured ourselves, which is what makes this more than a list. Every one of those legs traded on elevated volume and closed near the top of its daily range. Freeport, 235% of its median volume, closing at 77% of the day's range. Gold, 199% of volume. The Miners Fund, 175%. Southern Copper, 156%, closing at 89% of its range.
Uranium, 137% of volume, closing at 92% of range. MP, 123%, closing at 89%. Cameco, 112%, closing at 94.5% of its range.
Heavy volume, and buyers holding it into the bell. That is accumulation, not a short squeeze, and not a drift.
One thing we're not going to do is invent a reason for the uranium move. Uranium was the best sector on the board, and no catalyst was confirmed. The rare earth export control listing people are pointing at dates to June 22nd. It is not this week's news.
Now the opposite end of the same tape.
Utilities fell 2.28% on Friday, and they are down 7.6% over 20 days. Worst sector on both horizons.
About 20 large American utilities were oversold at the same time on our screen. Southern, PSEG, Centerpoint, American Electric Power, First Energy, Exelon, Evergy and Duke among them, with NextEra, Sempra, Dominion, Xcel, and Energy right behind.
And again, the volume settles what type of selling this was.
The utilities fund traded 126% of its median volume and closed at 1.7% of its daily range.
1.7%. That means it closed within a whisker of the lowest price it traded all day.
Southern, 103% of volume, closing at 1.1% of range. American Electric Power, 153% of volume, closing at 7.4%.
Elevated volume and sellers pressing right into the close. That is liquidation, not drift.
So on the same Friday, the metals complex bought on heavy volume closing at the highs, and the bond proxies dumped on heavy volume closing at the lows.
With one name that complicates the tidy version of that story.
Quanta Services fell 3.49% on 110% of its volume, closing at 12% of its range.
And Quanta is not a regulated utility. It is a grid contractor, paid to build the transmission, not to earn a regulated return on it. It should not trade as a bond proxy.
So either the selling is bleeding out of rate sensitives into the grid build-out theme, or this is one session in one name.
We do not know yet. It is on the watch list, not in the conclusion. The thing underneath both legs, and it has a date on it.
On August 18th, total U.S. public debt crossed $40 trillion for the first time. 40.047 trillion.
About 32.27 trillion of that is held by the public, 7.78 trillion in government accounts. The single-day increase was near $60.8 billion.
And here's the framing that lands it. The last trillion took 95 days.
The first trillion took until 1981.
The statutory limit is 41.1 trillion. A straight line gives 4 or 5 months of headroom, but debt subject to limit, the cash balance and extraordinary measures all move that, so there is no date to give.
On the Congressional Budget Office basis, the first 10 months of this fiscal year show a deficit of about 1.8 trillion and net interest of about 931 billion.
A Bloomberg survey of 392 respondents found about 2/3 expect the 10-year above 5% this year.
Our read rather than consensus. This is the engine under both halves of the rotation. The same force that bids gold sells the bond proxies. It is a bet on more issuance, not on more liquidity.
The 10-year across 3 sessions, 4.65, 4.69, 4.74%.
5 basis points on Friday, 4 on the week. Not a violent move. The direction is the point.
The Treasury also raised its long-end buyback cap from $2 billion to at least $4 billion per operation. That is debt management. It is not quantitative easing, and the two get conflated constantly.
2 Fed voices this week are worth having.
Mary Daly said the global rise in long-term yields weakens its usefulness as a signal about Fed policy. Long yields are being set by something other than the Fed. She called the labor market low hiring, low firing.
And Alberto Musalem said that without further tightening, the probability of inflation returning to 2% at the current level of rates is low.
Which is a fairly direct thing for a sitting policymaker to say out loud.
Then the single biggest move of the day, and it is a round trip.
On Thursday, Alibaba reported a 75% fall in net income, traded down to 121.88, and then closed at 130.53, up 1.26%, within 8 cents of its high for the day.
On Friday, it closed at 119.32, down 8.59%. That is below Thursday's panic low.
The whole reversal handed back in one session.
And the tape is emphatic about how it happened. 324% of median volume, and it closed at 1.4% of its daily range.
Thursday, it closed at 99.1% of its range. Friday, 1.4.
That is a mirror image. Sold all day on triple normal volume straight into the low.
Nothing in the numbers changed between those two closes. There was no new release, no guidance cut, no downgrade cycle that explains 8.5%.
What changed is that the market had 24 hours to read the earnings call.
Management guided that the AI investments break even in roughly 3 years, and that each major AI and server deployment turns free cash flow positive only in the 4th year.
Now put that next to the reported quarter. Capital spending up 75% to 67.7 billion renminbi, about $10 billion.
Revenue up 9%. Cloud revenue up 45%. and free cash flow was an outflow of 44.7 billion renminbi.
Citi wrote that capex up 75% with negative free cash flow could raise concerns around capital needs and investment returns.
So the beat was real and the spending was real. And the thing that moved the stock was the calendar attached to the payback.
Our read, not consensus. The market has not stopped punishing AI capital spending. It repriced the payback period.
Those are different claims. And the second one is more durable. A company can beat on revenue and still get marked down for telling you when the money comes back.
And here's what makes it a company story rather than a country story.
Q2 closed up 9.68%. NetEase up 6.98%. Alibaba down 8.59%.
And the China Internet Fund closed down 0.11%, effectively unchanged.
Three large constituents moved 7 to 10% in both directions, and the index did not move at all.
Each one was its own result. Q2's second quarter revenue was up 35.6% year over year to 7.2 billion Hong Kong dollars. Net income up 41.6% on record trading activity. It traded 294% of its median volume and closed at 91% of its range.
NetEase, second quarter revenue, 30.1 billion renminbi on gaming strength.
And Alibaba, the payback problem.
Note which way that cuts. On Thursday, Alibaba rose while the China Internet Fund fell nearly 2% and NetEase fell almost 6%. On Friday, Alibaba fell while both of those went the other way.
2 sessions running, it moved opposite its own complex. That is the clearest evidence yet that it is trading as an AI capital spending story that happens to be listed in China.
One figure went around this week that is worth taking apart. Hyperscaler AI-related debt at $1.65 trillion.
That number stacks 4 different things on top of each other, and the breakdown inside the same piece does not support the headline.
Money actually borrowed by the 5 large hyperscalers is about $445.8 billion. That is what sits on the balance sheet.
Signed, but uncommenced leases are about $831 billion. Those live in the notes until the lease starts. Add purchase and construction commitments, and you reach roughly $2.13 trillion, split across both.
So real borrowed debt is about $446 billion, not $1.65 trillion.
Shadow borrowing is a real term. The Bank for International Settlements used it in its March quarterly review. But these structures are disclosed. What changes is the legal borrower and the timing of recognition, not whether you can find them.
And there is plenty in there that is solid without the headline. Public bond issuance by those 5 went from about $28 billion a year through 2024 to $108 billion in 2025 to about $200 billion so far this year.
Buybacks collapsed over the same stretch. $48 billion in the fourth quarter of 2021, $12 to $13 billion 4 years later, $4.6 billion in the first quarter of this year. Alphabet stopped. Amazon has not repurchased since mid-2022.
Epoch AI has operating cash flow growing about 23% a year against cash capital spending growing about 70%, crossing around this quarter. And Epoch says all 5 remain profitable. Negative free cash flow is not a loss.
Morgan Stanley puts global data center spending at about $2.9 trillion through 2028, roughly $1.4 trillion fundable internally, $1.5 trillion needing outside capital.
The credit market is feeling it. Oracle was cut by S&P to BBB- in July, the lowest investment-grade notch, with capital spending going from about $21 billion to $56.
And the strongest argument on the other side. CoreWeave's GPU-backed financing cost fell from about 15% in 2023 to about 5.9% this year.
That is the opposite of a credit market in stress. Whatever this is, it is not subprime.
One more. And it is a number worth having right.
The Google and Marvell warrant covers a maximum of 58.97 million Marvell shares at an exercise price of $206.58.
That is roughly 6.7% of existing shares. Most of it vests in tranches against future purchase and revenue thresholds.
And Marvell closed Friday at $237.04, which is above that strike. The warrant is already in the money.
The stock also fell 5.57% on the day, the largest decline among the large AI-adjacent semiconductor names. On a day, the Dow rose almost 1%.
On 115% of median volume, closing at 19.5% of its range. So real selling, but not a distribution event.
And no company-specific catalyst was confirmed. It reports on the 27th.
Two other things from Friday's tape worth carrying forward.
NVIDIA traded 79% of its median volume below the market's own 83 and closed at 5.2% of its daily range. That is a fifth straight session at or below market volume into its own print.
And Target closed up 4.54% on 147% of volume at 99.2% of its range. Bought back hard 2 days after the Walmart session.
Ahead, Wednesday the 26th carries the week. NVIDIA, Salesforce, and CrowdStrike all report, and the July PCE inflation report lands the same day.
Then Marvell and Workday on the 27th, with Jackson Hole running the 27th through the 29th.
And the closing thought follows from Alibaba. It was marked down for how long its own capital spending takes to pay back. NVIDIA sits on the other side of that trade, the recipient of the spending, not the one waiting on the payback.
So the question for Wednesday is not NVIDIA's payback period. It is whether its customers' payback math starts showing up in their orders.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.